Welcome back. Goldman Sachs was the latest U.S. bank to report results early this morning. Those results exceeded analyst expectations. And once again, not for the first time this quarter, strong equity trading results were crucial to the results. Morgan Stanley, on the other hand, is the first of the six big banks to sell U.S. investment-grade bonds after reporting first quarter earnings. So there's lots to talk about. Let's do it with an expert. Gerard Cassidy is Managing Director and Head of U.S. Bank Strategy with RBC Capital Markets. Gerard, thanks a lot for joining us. One big theme here in these results so far is outstanding equity trading revenue numbers from the likes of Goldman Sachs, JP Morgan Chase, and Morgan Stanley. Not completely unpredictable, of course, because we knew there had been extreme market volatility in the quarter, and those expert traders are they are good at profiting off that type of volatility. But tell us your thoughts on what you saw in that part of the bank results.
No, you said it well, Paul, that the volatility in the quarter was extreme. And whenever there's volatility, that generally bodes well for trading results. And that was the case, as you pointed out, in the equity trading results for the banks that have reported so far, which again includes JP Morgan and Morgan Stanley on Friday, today Goldman Sachs, and later in the week we'll get Bank America and Citigroup numbers as well. But volatility is oftentimes very positive for trading, and we certainly saw that this quarter.
The offsets, however, perhaps from this market volatility, is that a lot of companies that would like to do deals of some kind are waiting until things stabilize, correct? And so investment banking was not a source of strength for Goldman or the others.
You're right in saying that. There was some strength earlier in the quarter in the debt capital markets. Traditionally, the first quarter is a robust quarter for debt capital markets, and we saw that this quarter as well. But as the quarter proceeded, and then, of course, when we got into April, which is not in the quarterly results, but certainly the Trump administration made their policy known in March about tariffs. That really started to weigh on the ECM business, equity capital markets, IPOs, initial public offerings, and then the advisory business. Now, the advisory business, of course, is a lagged business, meaning the deals get announced and it takes 6 months to close the deal, so the revenues don't show up. But that being said, the advisory business is kind of on hold now until there's better certainty in what the impact will be from these policies coming out of Washington, D.C.
The expectation, of course, of investors was that the Trump administration would significantly cut back regulation, making it easier for M&A activity to take place. I spoke with another person earlier today. He made the point that you've just made about revenue from investment banking deals being delayed by a period of months before it shows up in a bank's results. So he said that he thought the regulatory story was still there, still valid, but the benefit from an uptick in M&A may be pushed into 2026 now, he believes. Do you take the same view?
That certainly could be the case. It's certainly delayed, but I am certainly of the view, both in bank regulation and non-bank regulation, this new administration is going to be less onerous, we think, on the different industries, which would allow consolidation. They know, led by Treasury Secretary Bessent, that to enable the U.S. economy to grow faster, you've got to loosen up the regulatory corset, if you would, on the different industries. And that's particularly true for the banks. But I do believe it's also true for other sectors. So, yes, the regulatory outlook remains very healthy for consolidation in and outside the banking industry, but it has been delayed because of all this uncertainty. So we may see much greater activity later this year and into 26 because of this uncertainty.
So given the significant amount of uncertainty that are facing these financial institutions, what is your view of the stocks and valuations right now? All of them have come well off their peaks, and I think investors investors, retail investors who look at them, say, JP Morgan, it's not, in times past, it's not uncommon to look at a JP Morgan stock graph and see the stock trading at its highest price ever. Same with Goldman, same with Morgan Stanley, and they're now well off those peaks. What should investors think about when they see these share prices well off their peaks?
We think there's a good buying opportunity for selected names, particularly names that have the diversified revenue streams of a JP Morgan or a Bank of America, Wells Fargo. It's not as large on the investment banking side as those other names, but we think that they have a unique situation that's pertinent to them, which is the so-called asset cap. We think that will be lifted, which will give them growth opportunities. But yes, the stocks have come off their highs. If you assume that we're not going into a deep recession in the United States, similar to 2008 and 2009 or 1990, and it could be more of a softer, shallower slowdown, similar to 2001, which was actually a recession, but a very shallow one. The banks can work in those environments, and the diversified revenue names like the Bank of America, JP Morgan, and Wells is a way to play it, as well as the regional banks as well.
Right. One regional you like. I was just going to ask about it because I note you are bullish on this stock, M&T Bank Corporation. You've got a price target of $208. It's now trading at about 160. So you like this one a lot. It's a regional that does most of its business in the northeastern United States.
That's correct. Obviously, across the lake from where you're located and headquartered in Buffalo, New York. But it's a company that has proven over the decades that they know how to manage through credit cycles. They're well capitalized. They bought back a large portion of their stock this quarter. We expect that to continue going forward. And it's a real consistent, down the center of the fairway bank that we think at these types of prices offers investors a good time to get into it. The other thing, too, with all of these stocks, as you might imagine, Paul, is that the dividend yields are attractive, and the dividends are safe, they're well capitalized, and the banks are increasing their dividends annually, and we would expect that to be the case this year as well.
What kind of banks would you avoid in this market?
It's an interesting question. So the banks that could have issues are banks that have grown too fast. One of the precursors of issues with credit with any bank is a bank that grows their loan books way too fast, and they end up having trouble going into a downturn. So that would be certainly one category of bank. Another, of course, and we really don't have these amongst the large banks in the U.S., is a bank that's not well capitalized. But as I was pointing out, all of the large banks are well capitalized. In the banks in the United States, it's a rising tide lifts all ships, and a falling tide, lowers that as well. So it's hard to sometimes differentiate to find the bank that's going to do really poorly or really well, and everybody else is going in the other direction. They generally all move in the same direction, albeit at different rates of growth or different rates of decline. But rarely does one stand out and the rest of the group goes the other direction. That doesn't happen too often.
Gerard, thank you a great deal, as always, for your insight into an important part of the markets, the U.S. banks.